Alright guys, so let's talk about the dollar today. By now everyone knows the game. The dollar has been crashing hard thanks to the trade war. Now Trump has made it very clear that the old world order is not going to come back. Despite the economy contracting and US assets getting dumped, he's still going full speed ahead. Now 10% tariff on the world is in effect until July 31st and then everything could just revert higher. 30% on China which hasn't been resolved yet, and now his latest action just confirmed free trade is over. He's going to hit the EU with a 50% tariff starting in just a week. But observe the justifications he gave beyond just trade barriers. We have VAT tax, corporate penalties, and more importantly, monetary manipulations. And he's referring to Europe using interest rates to weaken the euro. So Trump's all in. He's going to unwind the entire trading system that kept the dollar as the reserve currency and a trading currency as well. It's really critical we sit back and observe what Washington is really trying to do. Trump wants the world to trade less with the US and to run the country like a self-efficient, self-sufficient economy. But that's not all. Luke Groman also made a very good point when it comes to the dollar being less useful. The government is doing everything they can to destroy dollar demand. Remember the Harvard foreign student ban? In other words, foreign holders of dollars are not allowed to purchase a Harvard education in the US. And if you're China, your dollars are also not accepted to purchase Nvidia's most powerful chips. Oh yes, let's not forget countries could be punished for buying Huawei's AI chips anywhere around the world. So now your holdings of the US currency is even less useful today. And we have to go through why this really matters and why this could cause the dollar to keep crashing. Now, firstly, tariffs are making it much harder for countries to sell to the US, especially countries like Europe and China who will face a 30 or even 50% tariff that might continue on forever. So exporters start to earn fewer units of the US currency. And if that's the case, why bother recycling your earnings back to US assets like Treasury bonds? Why maintain your buying power in USD when you can conduct trade in bilateral currencies? As a result, suddenly the demand for US assets starts to crater. At the very least, the buying won't be as furious as before. So the value of US bonds start to fall as well. And to make things worse, we have a type of global capital control going on from US sanctions. When you can't use your dollars to buy something anywhere in the world, that is a form of restriction, and it shouldn't be a surprise why the USD is falling in value. Now, you would think that the US government would be terrified, but maybe there's a deeper reason why. Perhaps the Trump administration wants the dollar to keep crashing because the incentives are simply too compelling. Now, the US national debt is unsustainable. Sooner or later, they have to inflate it away. Meanwhile, US exports are simply collapsing. Demand for US products have been dropping dramatically. Now, the port data tells us everything that we need to know. In a single quarter, demand for US exports simply collapsed. Cargoes from Los Angeles dropped by over 17%. Those are exports heading to China and other parts of Asia. The New York port, which is the gateway to Europe, also saw their exports fall by nearly 3%. So imagine what would happen if Trump goes ahead with his 50% tariff on Europe. Brussels would most definitely counter tariff the US. American exports would collapse even further. And this limits the options the US has. Here's the big question. How do you boost exports to the world while still imposing tariffs on them? Well, you weaken the dollar even further. You make the US economic situation so unfavorable that investors and countries just don't want to hold the greenback. Now, tariffs is one, but the US has more levers they can pull. Now, notice how Bessent is so zen when asked about the US bonds collapsing and the dollar crashing. He might just be sending a fatal warning about the reserve currency and he knows the end game. Now, during the interview, Bessent mentioned how he isn't bothered about US bonds collapsing and yields rising. And when asked about the falling dollar, he went into full deflection mode, and this part is really critical. He knows the dollar is heading down and spinning it to look like nothing really happened. It's like saying houses around your neighborhood all gained value, but yours didn't, and somehow that's a good thing for dollar holders. In addition to that, Besson also mentioned how the Bank of Japan is hiking rates and how the EU is spending money which is causing the euro to go up. And when Besson tells you a weaker dollar is fine, we better pay attention, we better believe him, because that could be the direction where we are heading. The dollar has dropped below the 4-year bullish trend. We are back to the dollar levels just before the Federal Reserve started hiking rates. So, what happens when interest rates eventually start to fall? Because we can't stay at the level of bond yields today without the US economy collapsing. And when the Federal Reserve starts to ease, the dollar might drop even lower than before, which is going to be really wow. So if you're still holding US bonds locking in at 5% for 30 years, you need to be very careful. Real inflation is still a problem, and if the dollar falls even further, and if you're a foreign investor, you might get toasted for the next 30 years. There's a very big lever that the US just pulled, and that's the big beautiful bill. Now, Trump's spending bill that revolves around tax cuts. It's crazy, but I want us to focus on how much it will add to the deficit. Now, over the next 10 years, at least $3 trillion will be added to the national debt, but the brunt of the deficit shock will come in the next 4 years. From 2026 to 2029, annual deficit spending will be at least $500 billion on average. In other words, Bessent will be flooding the market with $500 billion more in Treasury bonds every single year. Now, the supply will overwhelm demand. It will send both bond values and the dollar down. The borrowing is definitely to fund the bill, but we cannot deny the effects it could do to the dollar as well. Now, if the tariffs refuse to come down while you increase the supply of dollars in the US economy, something has got to give. More currency units in circulation means oversupply, which leads to a bigger dollar. Now, you might be asking, where are the dollars going to come from? If global exporters and investors refuse to buy, there must be another source of demand, right? Bessent wants to deregulate banks to force demand for treasury bonds. That is where the money is going to come from. He's going to ease the capital rule. Currently, US banks need to hold a certain amount of capital relative to their assets like loans and even bonds. However, holding treasuries also counts to that limit. Bessent wants to allow banks to hold as much treasuries as they want without holding capital to back it up. Now, needless to say, this is a very, very risky move, but it's a desperate attempt to get buyers of US bonds when global investors they're all saying no. Now, this might provide the US with money to fund the bill, but it still doesn't solve the dollar problem. Demand will still be weak as long as the tariffs last. So we have to brace for impact. The dollar could fall much lower than we all think. It's down by 10%, but if Trump wants to eliminate the trade deficit, which he calls an emergency, there's more downside to go. Now, according to Deutsche Bank, the dollar will have to fall by 40% in order to wipe out the trade deficit. Essentially, they are saying that US goods needs to be 40% cheaper for global importers to buy, and this will help ramp up demand for US goods and services. Now, Trump will finally be able to narrow the trade deficit and get industries exporting again. Now, this sounds great, and yes, slamming down the value of the dollar by issuing a ton of bonds will most definitely work. But there are major consequences for this. There's no free lunch at all, guys. If we move towards a devaluation of the currency, there's no escaping the impacts. And if the USD drops by 40%, imported inflation will soar, at least in the initial stages before all other currencies devalue. So, gas, electronics, food, everything gets more expensive. More importantly, this could trigger the end of the reserve status of the dollar. Now imagine if you're a central bank holding billions of US bonds, suddenly the dollar crashes by 40%. It will wipe out decades of gains. You might even be in the red. So in real terms, especially in your local currency, you might have suffered massive losses holding US bonds, and that could trigger the final stage. And this is where we have to be a little nuanced here. If a massive devaluation happens, it doesn't mean that the dollar value of US assets drop. It might still go up. But in terms of real value and other assets, it could still be a hot potato. Its value could rise by 30%, but what's the point when the currency falls by 40%? So Bessent and Trump can solve the trade situation by devaluing the dollar. And whether it's through a Plaza Accord 2.0 or through a tsunami of bonds, there will be many losers. And if we look at real assets, they're already responding to the trade war. It's as if everyone knows the end game is devaluation, because that's perhaps the only way left to solve the trade and the debt situation. Gold, for example, has risen by 2% after Trump's tariff threat to Europe. And this moves it closer to $3,400, and it's a signal that the dollar is really breaking down. Investors are betting that US bonds or the dollar would break, or perhaps both, so they're hedging with gold. The problem once again is crazy government spending. It happened with Biden and it's still happening with Trump. However, things can always get crazier. Now, a few days ago, Trump decided to go full Star Wars. He's going to build a golden dome around the US, and guess what? It's going to cost a lot of money.
Mr. President, add this to the long and growing list of promises made and promises kept. Ultimately, this right here, the Golden Dome for America, is a game changer. It's a generational investment in the security of America and Americans. Now it is, and you're following through to say we will protect the homeland from cruise missiles, ballistic missiles, hypersonic missiles, drones, whether they're conventional or nuclear.
The one big beautiful bill will include $25 billion for the Golden Dome to help construction get underway. That's the initial sort of a down deposit. And we have probably, you're talking about, General, we're talking about $175 billion total cost of this when it's completed.
Now, this is crazy. Is this the modern version of the Iron Curtain? Who are they protecting the US from? Is it the entity from Mission Impossible? But what's not funny is the price tag on this. According to Trump, it will cost $175 billion to make it happen. And it's part of the current tax bill, but seriously, do you think it will just stop at that amount? According to the CBO, this might cost up to $540 billion. Other estimates are more realistic, they're less generous. This could hit a total price tag of $1 trillion. And if Trump wants to make the dome operational in 3 years, it means a bulk of additional spending will have to be accelerated. So once again, we have a bigger tsunami of bonds coming. And this is the state of the US fiscal crisis today. It's one new project after another to justify even higher deficit spending. We have gone from one crazy extreme to the other. And if Trump really pumps up the deficit quickly, he could push us closer and closer towards a real currency devaluation. Now, thanks to the big beautiful bill, we are moving towards a fiscal crisis during a trade war, which means collapsing demand for US bonds as well as falling demand for the reserve currency. The buying will have to come from local investors, which will just drive yields and the national debt higher at the same time. Now, we have swung from a potential recession to a fiscal crisis. And when Trump started his trade war, he held fiscal policy too tight, vowing to cut government spending. But now we have made a big pendulum swing back to easing through more spending. There's no more Doge, and cost cutting is now a thing of the past. We are back on the fiscal train to devaluation hell. But let me know what you think. Is the end game making the dollar a whole lot weaker? And is there no other way out now? Let me know in the comments below. Stay safe. Be sure to smash the like button and subscribe as we navigate through these crazy times.